Your accountant just cost you your mortgage, and they have no idea they did it. That deduction they celebrated, the one that saved you $12,000 in taxes last year, it just told your mortgage lender that you are too broke to buy a home. And the worst part, it was completely legal, completely above board, and it is happening to self-employed people every single day across the US, Canada, the UK, and Australia. I have watched six-figure earners, people making $200,000, $300,000 a year, sit across from a loan officer and get told they don't qualify. Not because their credit was bad, not because they had too much debt, because the tax strategy their accountant built for them made them look broke on paper, and nobody warned them that was coming. So stay with me. Because in the next 20 minutes, I'm going to show you exactly how this happens, why the system is structurally stacked against self-employed borrowers in a way that almost nobody talks about openly, and the three-move strategy that fixes it. And at the end of this video, I am going to show you 5 hidden mistakes that kill self-employed mortgage applications in underwriting mistakes that have nothing to do with your income or your credit score, and one of them is almost certainly sitting in your financial picture right now. Let's go. There are 2 financial systems running in parallel in the United States, Canada, the UK, and Australia. They look like one system. They feel like one system, but they are not. There is the system built for W-2 employees, salaried workers, people with a pay stub and a T4 or a P60 or a PAYG payment summary. And then there is the system that self-employed people are forced to navigate. Different rules, different documentation requirements, different qualification calculations, different consequences. This is not a conspiracy. Nobody sat in a boardroom and decided to make your life harder. What happened is that the entire mortgage and lending infrastructure was built around one model of income, stable, predictable. Employer-verified income and self-employed income does not fit that model. And the gap between what you actually earn and what a lender is willing to recognize is where your mortgage qualification goes to die. Comment 2 systems right now if you have ever felt like the financial rules that apply to you are different from the ones that apply to everyone else, because they are. And I want you to be crystal clear on that before we go any further. Now let me show you the specific mechanism, because this is where it gets real. Think about how much you wrote off last year. Your home office, your phone, your subscriptions, your vehicle, your travel, your equipment, your professional development, your health insurance premiums. Add those numbers up in your head right now. Did you reduce your taxable income by $20,000, $40,000, $80,000, more? Here is the question your mortgage lender is going to ask, and this single question is responsible for more shattered home ownership dreams among self-employed people than any other factor in the entire lending process. What is your net income? Not your gross revenue, not your top-line number, not what hit your business bank account. Your net income, the number after every single deduction has been applied, the number on line 8 of your Schedule C if you are in the US, your net professional income in Canada, your profit figure on your SA 302 in the UK, your net business income on your Australian tax return. That is the only number a conventional lender will use to qualify you. They divide it by 12. They run it through their debt-to-income formula. They use it to determine how much house you can buy, or whether you can buy one at all. And if you have spent years legally minimizing that number, congratulations, you have been minimizing your borrowing power at the exact same time. Every dollar you deducted saved you money in taxes and cost you purchasing power in the mortgage market, and nobody told you that was happening. Now here is where I want to show you exactly what this looks like with real numbers, because abstract concepts are easy to dismiss. Real numbers are not. Meet Maria. Maria is a freelance graphic designer in Austin, Texas. She has been self-employed for 4 years. She grosses $210,000 a year. She has a down payment saved. Her credit score is 740. Her tax accountant is excellent. Maria deducts her home office, her software subscriptions, her professional development, her business travel, her vehicle depreciation, her health insurance premiums, and her SEP IRA contributions. After all of that, her net income on her Schedule C is $68,000. Maria applies for a conventional mortgage. The lender takes her last 2 years of Schedule C net income, $68,000 and $62,000. They average them $65,000. That is her qualifying income, $5,400 a month. The median home in Austin is over $500,000. Maria makes $210,000 a year. and cannot qualify for the home she wants. Not because she does not earn enough, because the system only sees $65,000 of what she earns. Does that make you angry? Good, it should. But here is the part most people miss. Maria's accountant was not wrong. Her deductions were legal. Her tax strategy was smart. The problem is that nobody, not her accountant, not her financial advisor, not her mortgage broker, ever told her that her tax strategy and her mortgage strategy were running in opposite directions. That you have to plan for both simultaneously years in advance. That the decision you make on your tax return this year is a mortgage decision for 2026 and 2027. Nobody told her, and that information gap is expensive. But now here is where I need to say something that is going to make some accountants uncomfortable, and I want you to really hear this. Hot take, and I mean this seriously. Your accountant may be the single biggest obstacle between you and your next home. Not because they are bad at their job, because they are excellent at their job. Their job is to minimize your tax liability. They are laser focused on that one outcome, and they are winning. But every time they win on taxes, they are quietly losing the mortgage game on your behalf. And because the mortgage conversation happens in a completely different office with a completely different professional on a completely different timeline, nobody ever connects those two outcomes. Your accountant does not see the mortgage denial. Your mortgage broker does not see the tax return until it is already filed. And you are the one sitting in the middle paying the price for a coordination failure that nobody told you to prevent. Fight me in the comments if you disagree. But I have seen this pattern repeat itself too many times to stay quiet about it. Comment accountant if your tax professional has never once asked you about your mortgage timeline, because I am willing to bet that the majority of you have never had that conversation. And that silence is costing you. Now, here is something I need you to understand before we get to the solutions, because the income number is just the beginning of the problem. Even before a lender looks at your income, they are going to put you through a documentation process that your salaried neighbor will never experience in their lifetime. And this is where a lot of self-employed applications quietly collapse before they ever reach the income calculation. When a W-2 employee applies for a mortgage, the lender calls their employer, verifies employment, looks at 2 pay stubs, done in 48 hours. When you apply, the lender wants 2 full years of personal tax returns, every page, every schedule. They want 2 full years of business tax returns if you have an S-corp or a partnership. They want a year-to-date profit and loss statement prepared by a CPA. They may want 12 to 24 months of business bank statements. They may want a signed CPA letter on firm letterhead verifying your business is active and your income is likely to continue. And after all of that documentation, after you have handed over more financial information than most people see in a lifetime, they run your file through an underwriting system designed for people who get a paycheck every 2 weeks. You are playing an entirely different game, with an entirely different rule book. And if you walk in assuming the rules are the same, you will lose. Comment different game if this is landing, because I want to know how many of you felt this the hard way. Now here is what most videos on this topic completely ignore, and this is the part that expands the problem from frustrating to genuinely alarming. The mortgage is the most visible place this trap bites you, but it is not the only place. The self-employment deduction trap shows up in 4 areas of your financial life simultaneously. And most self-employed people never connect the dots until the damage has already been done in multiple places at once. The first is mortgage qualification, which we just covered. The second is business financing, SBA loans in the US, Canada small business financing loans, business development loans from UK banks, small business loans in Australia. All of them use your net business income from your tax returns to assess your credit worthiness. If you have been maximizing deductions, you have been telling every lender in every category that your business is less profitable than it actually is. Less profitability on paper means less access to capital. That affects your ability to grow, hire, buy equipment, or survive a slow quarter. The third is income protection and disability insurance. In all 4 countries, your disability benefit is typically calculated as a percentage of your insurable income. Your insurable income is your reported net income after deductions. So if you are grossing $200,000 and your net after deductions is $60,000, your disability payout is calculated on $60,000. If you cannot work for a year, the insurance pays you a fraction of what you were actually living on. You have insured a number that has nothing to do with your real financial life, and you probably do not even know it. The fourth is rental applications. In major cities, high-end landlords require income verification. Self-employed applicants are asked for tax returns. Low net income on that return can get you denied for a rental, even though you earn more than the person who got approved. Your deduction strategy can block you from renting the home you want before you are even ready to buy one. 4 systems, all using the same number. The number you have been carefully and legally minimizing. That is the full shape of the trap. So how do you get out of it? 3 moves. Let's go. Move 1 is the add-back calculation. And if you have never heard this term in the context of mortgages, type ADD back in the comments right now. Because this single concept can shift your qualifying income by tens of thousands of dollars without changing a single thing about how you run your business. An add-back is a deduction that a mortgage lender will allow you to add back to your net income when calculating your qualifying income. The logic is straightforward. Not all deductions reduce your actual cash flow. Some are non-cash expenses, accounting entries that lowered your taxable income but did not require you to write a check this year. The biggest one is depreciation. If you purchased equipment, a vehicle, or other business assets and claimed depreciation, that depreciation reduced your taxable income without reducing your bank account. The cash left when you bought the asset. The depreciation is the accounting spread of that cost over time. And many lenders, not all, but many will add that depreciation back to your qualifying income. Here is what that means in real numbers. Your Schedule C shows net income of $68,000. Buried in your deductions is $32,000 of vehicle and equipment depreciation. A lender who processes self-employed files correctly adds that $32,000 back. Your qualifying income is no longer $68,000. It is $100,000. That difference translates to roughly $150,000 additional dollars in borrowing capacity depending on rates and other factors. But the add-back only works if you are working with a lender who knows how to process self-employed files correctly. Most standard bank loan officers are trained on W-2 income files. They see your net income, they use it, and they move on. They do not go looking for depreciation to add back. They do not know to ask about your Section 179 election. They do not read your schedules the way they need to be read. You need a mortgage professional who specializes in self-employed borrowers. Full stop, non-negotiable. This is the single most important professional relationship in your mortgage process. And most self-employed people do not know this specialist category even exists. Now here is the transition that most people miss entirely. And this is the part that determines whether Move 1 actually works for you or just sounds good in theory. Move 1, the add-back, is a reactive strategy. It works with the tax returns you already have. But what if your tax returns from the last 2 years are so heavily deducted that even with add-backs, your qualifying income is still too low? What if the depreciation you claimed is not enough to close the gap? What if your qualifying income comes out at $70,000 when you need it at $120,000 to buy the home you want? That is where Move 1 runs out of road. And that is exactly where Move 2 begins. Because Move 2 is not about reading your existing returns differently. It is about making different decisions before you ever file. Move 2 is what I call the dual track strategy. And this is the biggest mindset shift in this entire video. Right now, if you are like most self-employed people, you have a tax strategy and a lending conversation when you need it. These two things happen separately, managed by different professionals with different goals. Your tax advisor is pushing your net income down. Your mortgage qualification needs your net income up, and nobody is managing both outcomes at the same time. The dual track strategy changes that. It means making tax decisions with your lending window in mind. It means that if you are planning to buy a home in the next 2 to 3 years, you are having a conversation with your CPA right now today about which deductions to take, which to defer, and how to structure your income so that the 2-year average your lender will use reflects your actual financial strength. Here is a concrete example. You want to buy a home 18 months from now. You have the option to buy $70,000 of equipment this year and write it all off immediately under Section 179, the full deduction this year. Or you could finance the equipment and depreciate it over 5 years, taking a smaller deduction annually. If you take the full Section 179 deduction, your net income drops by $70,000 this year. That lower income enters the 2-year average your lender uses. If you depreciated over 5 years, your income is higher this year by roughly $56,000. Your qualifying income improves significantly, and your mortgage eligibility changes dramatically. You are not giving up the deduction. You are timing it strategically relative to your lending window. That is the dual track strategy in action. Tax efficiency and lending eligibility planned together, coordinated in real time, not running in opposite directions. Comment dual track if you are going to bring this concept to your next conversation with your CPA. Because this one move, coordinating your tax strategy with your mortgage timeline, is worth more than any individual deduction you have ever taken. Now, move 3 is for the people watching this who need a mortgage sooner than 2 to 3 years. Because I know some of you are thinking, I hear everything you are saying, but I need to buy in the next 6 months. I see you. Here is what exists for you. There are mortgage products designed specifically for self-employed borrowers that bypass the tax return income calculation entirely. The most significant one in the U.S. is the bank statement loan. Instead of using your Schedule C net income, the lender uses your average monthly deposits from 12 to 24 months of business bank statements. They take your deposits, apply a standard expense ratio based on your industry, typically 30 to 50%, and calculate your qualifying income from what actually came into your accounts. Back to Maria. $210,000 deposited into her business account across the year. Lender applies a 40% expense ratio. Her qualifying income is $126,000, compared to $65,000 from her tax returns, nearly double. And that difference is the home she wants versus the home she was told she could afford. Bank statement loans carry trade-offs. Slightly higher interest rates, typically half a point to a full point above conventional. Larger down payment requirements, often 20 to 25%. And they require clean, organized bank statements with consistent deposit patterns. If your business and personal finances are running through the same account, your statements are going to be messy, your story is going to be harder to tell, and your options narrow significantly. In Canada, some lenders offer business for self programs with similar structures. In the UK, specialist lenders and certain building societies assess applications using bank statements and accountant projections. In Australia, low doc and alt doc loan products serve the same function with similar trade-offs. These products are the bridge when you cannot wait. The permanent solution is always the dual track strategy, building a 2-year income history that reflects both tax efficiency and lending eligibility simultaneously. But the bridge exists, and knowing about it means you have real options when time is not on your side. Now, I want to step back from the strategy for a moment and say something that needs to be said directly, because this is the thing that sits underneath all of these numbers and strategies, and I do not want to skip past it. You chose self-employment because you wanted something more. Freedom, control, the ability to build something that belongs to you. You went without a safety net. You covered your own health insurance, and in the U.S., a family plan can run $15,000 to $20,000 a year out of your own pocket. You funded your own retirement with no employer match. You paid self-employment tax 15.3% on your net self-employment income before income tax even applies. In Canada, you paid both sides of CPP. In Australia, you funded your own superannuation with no employer contribution on top. You managed your own cash flow through months where revenue was unpredictable. You sent estimated quarterly tax payments to the government before you even knew exactly what you owed. You carried all of that. You built something real. And when you walk into the same financial institutions that your neighbor with the corporate job walks into the neighbor with the guaranteed paycheck, the employer-matched retirement, the company health plan, you face a more demanding qualification process, a more complex documentation burden, and often a higher interest rate or down payment requirement. Even though you may be building more genuine long-term wealth than they ever will, that is a structural imbalance. It is real. And the self-employed people who build genuine lasting wealth are the ones who stop assuming the rules that apply to salaried employees apply to them and start building their financial lives with an accurate map of the actual terrain they are navigating. You now have a better map than you had 20 minutes ago. But here is what I did not tell you yet, and this is the part that I genuinely need you to stay for. Everything in this video, the add-back calculation, the dual-track strategy, the bank statement loan, all of it assumes that your financial file is clean enough to present to a lender. And for a significant number of self-employed borrowers, it is not. Not because of income, not because of credit. but because of 5 specific mistakes that self-employed people make in the way they set up and manage their finances, mistakes that exist long before the mortgage conversation even starts and that cause underwriters to technically decline files that should have been approved. One of these 5 mistakes is so common that more than half the self-employed people watching this video are making it right now, today, without knowing it. It shows up as a specific pattern in business bank statements that makes underwriters immediately uncomfortable. It does not matter if your income qualifies. It does not matter if your credit score is 800. When an underwriter sees this pattern, the risk flag goes up, and the file gets scrutinized in a way that can kill the application before it ever reaches final approval. In the next video, I am walking through all 5 of those mistakes. I am going to show you exactly what underwriters see when they pull a self-employed file, what makes them nervous, and what makes them confident. I am going to show you how to identify whether any of these 5 mistakes are currently sitting in your financial picture. And I am going to show you how to fix each one before you ever fill out a mortgage application. Do not implement anything from today's video until you watch that one, because you can execute the add-back calculation perfectly, coordinate your tax and lending strategy flawlessly, find the right specialist lender, and still get denied in underwriting because of one structural problem in your file that nobody warned you was there. I will see you in that one.